welcome to the Startup Success Series. My name's Poppy Chihuela. I'm the Director of Programs and Partnerships at Startup Vic, and I'm going to be your host today. Now, if you haven't come across Startup Victoria before, we're actually one of Australia's largest networks for entrepreneurs. There's about 60,000 people in our community, so you're in good company today. Startup Victoria, we exist to support founder success. So basically what that means is trying to help you build and scale your business while staying healthy as a founder as well, because we know it's not an easy journey. If you'd like to find out more about us, you can go along to our website. You can read more about how we can help and maybe even sign up for a membership. Now, today we're going to be talking about Safe Notes. And I don't know whether you had to look up that acronym, but I did. It stands for Simple Agreements for Future Equity. These days, there are lots of different avenues you can go down to fund your business and find capital. But if you're not a lawyer or you're not a financial expert, it can be a little bit difficult to navigate which one is right for you and which one makes the most sense for your business and your context. And Safe Notes in particular are getting more and more popular in the Australian landscape at the moment. But what exactly are they? And when do you know whether you should be using them? Fortunately, we've got an expert in the room today, and it's definitely not me. It's Jason Atkins, who's the CEO and co-founder at Cake Equity. For those of you that haven't come across Cake before, in simple terms, they make it really easy for startups to raise capital and grow. And if you haven't come across them, I'd highly recommend you check them out, especially if you're on that capital raising journey. They are fantastic. Hey, Jason, how are you doing today?
Yeah, awesome. Yeah, good to be here. A little bit of a fish out of water today, or out of water, yeah. Gold Coast flooded down here in Sydney in fish burners, so it's nice to be, it's nice to be in Sydney and joining you all here for the session as well.
Yeah, awesome. And I'm glad you're a fish out of water, Jason, and you're all safe and dry in Sydney.
Yeah, it's tough up there up north, eh? Feel bad for people in the floods, but yeah.
Yeah, sending best wishes actually to anyone who's dialing in today from that area of Australia. I hope everyone's okay. In terms of how it's going to work today, then, I'll be shortly handing over to Jason to take over and run a bit of a presentation for 30 to 40 minutes and give us some more details on Safe Notes. And then I'll be jumping in when we've got about 10, 15 minutes left at the end to answer some of your questions in the audience. Over to you, Jason. Take it away.
Yeah, that's a really great way to start the presentation, just by me saying, with capital raising, there's just a huge amount to learn. And one of my missions in the last 5 years is to try and simplify everything as much as I can, as a leader. And at Cake, certainly my whole team is committed to trying to simplify these processes as much as we possibly can. It is still quite a lot to take in. Today, I'm going to talk to the real newbies, certainly, but also try and give enough context and enough technical information for those that are looking for it as well, and just try and balance that out so that I don't bombard you with too much information. It is my goal coming into this to try and help you be able to, from this one session, if you take notes and maybe just watch it one more time or whatever. I don't want you to have to go, really far past this session without knowing how to do this, right? So let's do our best to keep it simple and help you crack this in one go. Our vision at Cake is to empower millions of entrepreneurs globally to build a better future, and also to share in success in a more equitable way. So, Safe Notes do help with that, because they help you get more angels on early. And then if you go on to be really successful, they can share in that success. And it also helps you as founders to get those early, really tough rounds done when you haven't got any runs on the board. So I think this session really ties into our vision. So we are the market leader in Australia. I only really share this just in case you were wondering if you should really listen to us or not. We've got 1,000 startups on Cake now, capital raising, ESOPs, cap table stuff. We've been absolutely dedicated to this for, several years now. You can see down the bottom there, our numbers are really exploding. So, we've got a lot of lessons in this that we try and bring to these sessions. So we're working with the best people in the country as well. So right now, Cake is working with Hall Chadwick and our good friend Dave Kenny, who's a bit of an icon, in my opinion, in startups. He's done so many things, and so well respected, and also the wonderful guys at Archangel to analyze what the safe note is and where its shortfalls, could be, and the misunderstandings could be, and how we could make a better safe note or a safer note. So we're going to go through that a little bit as well. We also have wonderful partnerships all around the ecosystem, including Startup Vic, and huge fans of what they're doing, and especially love how you talk about founder health. I'm so passionate about that, and it's really critical. So look, what's the overall background that we're working on here? The ecosystem is just absolutely pumping. If you didn't see the report out this week from Cut Through Ventures and Folklore, Cake was a partner on that. Please do check out that report. There's a lot of great information in there, and as founders, the more information we have, the more better we can be. And the good news is, nearly a 70% increase in rounds in 2021. So, look, there has been a bit of a collapse in the listed space, with share prices and stuff. And so, you might just need to be a bit aware of that when it comes to valuations. But look, great time to be raising still, not expecting any big dramas from any of that stuff in 2022. Certainly not in the short term, which is nice considering all the turmoil going on in the background. So today we're going to focus on the very beginning here, the whole valley of death, where many of us are. I think Cake it's funny, they call Series A your first round, which is fairly humorous to most of us founders who have scrapped and battled our way through 1 or 2 or 3 or 4 rounds by the time we get there. But anyway, this is our journey, and Safe Note's very, very popular and common in here, and becoming more popular and common, and we're going to go through how you can use it successfully through that period. So, your 3 typical first rounds, friends and family can sort of happen before pre-seed. I don't really call that a round. You might actually use a safe to sign up your uncle or your brother or your mum or dad or whatever as well. But I think the most common round here for a safe would be the pre-seed. It's very common for the first round to be done as a safe. Going back 3 or 4 years, it would have been a convertible note, most likely, before safes became quite popular in Australia, particularly. So, yeah, really common instrument for the pre-seed. The seed round is normally like a priced equity round, so you're actually issuing new shares, and Series A is very much shares as well. The safe can be used in between seed and Series A. It can be termed a bridging round. I actually don't like the term bridging round. I only learned this recently. It's amazing how much you need to learn after all these years. But a bridging round normally signifies it's a down round. So just say you had done your seed round at, say, 5 million pre-money. If you're doing, say, a seed plus in between your Series A, but it's at, say, an $8 million cap or a $10 million cap, then you wouldn't call that a bridging round. You would just call that a seed plus or a seed 2. So the seed plus, seed 2 quite often can be done by a safe as well. So the very first round and then the rounds in between. But the seed and Series A are normally done with shares because you want to lock your equity in as regularly as possible so you don't end up with tons of safes all stacked up on top of each other. It can be difficult to work out exactly where your whole cap table is, and you can cause yourself some chaos if you're not regularly doing those proper share rounds at those key times. So how does safes work in relation to dilution? The way I sort of look at a safe is it's like a pre-funding of your next round. So if you're in between seed and Series A and you do a safe, you sort of plan out the safe and the Series A together as, 2 parts of the same round or 2 rounds, but you're always thinking in your mind, what's the likely Series A valuation and when's that going to occur? And what's the dilution going to be of the safe round and the Series A round together? So, whenever you're doing a safe, you're always trying to think about it as sort of like a prepayment that you're receiving from investors ahead of a future priced round, price share, like a share round, just so that you don't just accidentally, and it is easy to do that, especially early on, get a bunch of safes with big discounts on them. And then you run the next round and you're like, oh, whoops, I just smashed my cap table and I've got like half as much equity as I thought I did. And it's not totally uncommon for things like that to occur. So be a bit careful. So I'm not going to be super technical on this call. It's not, I don't really see that as my role. Feel free to ask me technical questions. I am going to answer, I'm going to put some technical information in here, but I intentionally try and simplify this as much as possible and just give you enough information so that you can be effective without bogging you down too much. So look, capital raising in general is just very complex. So this is just a slide to talk about the general complexity. Safe notes are no different. They're quite complex. There's normally the actual legal agreement. There's the spreadsheeting of your cap table. There's all the meetings and follow-up and, lodgements, not necessarily with the safe, but when the safes convert to shares, you need to make sure you lodge with ASICs. It's just a lot to do. So it's important to follow a tried and tested process. There is real process principles as a market out there. Investors know they know all this stuff. As a founder, it can be hard, but investors are doing this, week in, week out, month in, month out. And so they really do understand what the process is. And what I'm trying to do here and with this capital raising toolkit that the Startup Vic team are going to share with you, there's a lot of tips and tricks in there to make life easy for you. The capital raise is run in 3 distinct phases: preparation, marketing, and closing. If you're not using those 3 distinct phases, you're really going to cause yourself some trouble. So the first phase would be preparation. So this is the actual, checklist from the capital raising toolkit. Just going to check my watch so that I don't ramble on too long. So you've got a short pitch deck, a long pitch deck, the data room. You're going to do evaluation. Now, when you do a safe, you don't need evaluation. You might want to still do one, just a really simple one, really quick one, just to have a rough idea what you think you could be worth at this round. But technically, there's no valuation included in a safe, so you could run around without a valuation altogether. You would normally do a simple financial model. You've got to prepare the cap table. So how many shares on issue? Do you have an employee option plan? And you put the safe in there as well. So, however much money you're looking to raise in the safe, you put that into your cap table model. So obviously choosing equity, convertible note, or safe is a decision you need to make. You don't have to go with a safe. We're going to talk about what the benefits are and why perhaps you wouldn't use it during this process as well. Building your investor list. And sometimes while you're building your investor list, they'll actually tell you if they would prefer you to be using a safe or just using shares. Sometimes there's no real benefit to doing a safe. So that you do need to sort of work that out as you're preparing. And then get a startup lawyer and accountant. So I always talk about this. If you've got your mum or dad or uncle's accountant or lawyer from their traditional business or whatever, I would normally argue that you should switch to one that works in startups because it's quite different and you'll probably get a better outcome, save yourself some heartache and a bit of money. So then you go to the marketing phase. This is a bit where you're out and about, you're having your emails and your meetings and you're following up. Where a safe, what's different about a safe here is that quite often there won't be a term sheet and there might not even be a lead. So it can be called a party round. So the very first round, quite often called a party round or, when there isn't a lead. So it is a bit different. So quite often you want to take a standardized safe to the round instead of expecting the investor to give you terms. And this is actually quite a powerful dynamic when you're out there raising, because you can be saying, I'm using standard terms and I'm a good startup, just sign here, as opposed to all this ambiguity about what's going to happen and needing a lead and needing someone to vouch for you. You can sort of just go out into the market and say, no, I'm running a $400,000 safe pre-seed. These are my milestones, here's my deck, and here's my safe, and it's on standard terms. And I really do try and promote this type of interaction. The more standardization we can have in the market, the better. The more companies are going to get funded and the less hassle you're going to have raising. Whereas with an equity round, it's a bit different. You would normally be looking for a lead investor to give you a term sheet, with the valuation and things like that in it. Then, of course, you still have a due diligence sort of process there. In the very first round, it's obviously very minor because you have very few documents and very few things that you can prove because you don't have many runs on the board. And then once you've got I guess with a safe round, with the marketing phase, before you go to closing. So what would not with a share round, if you're issuing shares, normally what happens is you get a term sheet or you get a lead investor, and then you go and you close everybody else that you've talked to see who else wants to participate. Or sometimes the lead investor takes out the whole round or whatever, and there's no room left. But just say you're raising $1 million and you get a $600,000 lead, you'll go around to all your other investors and close out the other 400,000. With a safe note, it's similar. So for example, if it's a pre-seed, you might have 30 meetings and you do, follow-ups with 10. One of them will say, all right, well, I'm in for 100K out of say 400K or whatever. And then it's quite similar. You'll go around to all the other investors and say, look, I've got somebody in, who else is in? And then you chase around and see how much you can get. You might end up with $300,000 worth of demand. You might end up with 600, and then you just sort of need to close it out as best you can. With a safe, and look, none of this is legal or financial advice, even though I am an accountant and we're very good at this stuff. Like, I must say, like, please, this is all just general experience and knowledge. So if you do need legal advice, we have legal partners. I'm sure Startup Big can introduce you to good people as well, and so on and so forth. But this is from my experience, which is fairly extensive. But with the safe, let's talk about closing out the safe. So with a price round, so with a share round, when you're closing, you normally have to hit the minimum. So just say you're raising $1 million and you only get $700,000, technically you're supposed to give all that money back, or you have to go back and renegotiate the whole round, reissue the offer doc. There's a lot of technical, difficult, legal mumbo jumbo stuff you got to go through. It's probably doable, but it's going to be a huge pain in the butt. With a safe round, you don't really need to do that because every single agreement is an individual agreement with every investor. So as long as you get close to what you were raising and you've been open with the investors and you haven't, tricked or lied or said anything wrong or anything, if you just say you're going for 400 and you get 300, you can just lock in all that money and keep going, which is a big advantage and a big difference around closing with a safe. I better keep going. There's quite a lot of slides. So, so even though this is not a sales pitch by any stretch, we've spent years building a system for safes. And so I just have to say, because I honestly believe this, Cake has a fantastic system for running a safe round. Everything's into one place. The legal, hopefully Poppy isn't going to get up me for this slide, but there's the safe agreement is built in. It's industry standard. You can edit it if you want. If you've got your own lawyer, you can edit it, or you can bring your own safe and use all the automation. So there's automated signing and integrates with the cap table, and you can convert a safe to shares. Like, there's just so much hassle, time and money saved by doing this in Cake. I do recommend, if you're going to use it though, book in with our customer success team, make sure your cap table is set up properly and get them to show you how to use it, because capital raising is so complex. And even though Cake is save a ton of time and stuff, you do need to be shown how to use it. Otherwise it's a bit, you can make a mistake and cause yourself a bit of heartache. So apologies, I have to do that because I really believe in it. But anyway, totally make your own mind up and whatever. So yeah, cool. Now, this is like just from founder to founder. Like, I'm like a 4th or 5th year founder now, and I'm still learning. And but I care about all the community, and so look after your health and your mental health. Capital raising is an unbelievably difficult thing to do, and you've got to do it on top of everything you're already doing. It's often said that it's like a full-time job for one founder on top of whatever, God knows whatever else you're having to do. So look after your health, see people if you need to, get the support you need to get. Tie-ins, accelerators and incubators, they're just magnets for investors and knowledge and experience and support. I just can't speak highly enough of them. I'm involved in several, and we went through StartMate, and without all that stuff, like, it's just so hard. Get the right resources like our capital raising toolkit and this presentation. Just learn and keep learning. Like, every single time I raise, I just learn more, and I'm pretty amazed at how much there is. Tap into your purpose. This is, really just about, I think I've got a slide for this on the next slide anyway, but here we go. So when you're raising, the number one thing, especially early on, that investors are backing is you and your vision and where you're going, your purpose. If you can't really articulate that unbelievably well, you're just going to have such a bad time, and it's going to take so much longer. So even though this is not about safes, I just had to add it in on the whole capital raising side of things. So, all right, so we're going to get a little bit more into the technical side of things now. After I was trying to paint more of a overall capital raising picture for the first bit. I'm going to set a little time reminder here because it's like so complex and I just don't want to kill you with details. Right, so it's a simple agreement for future equity. So the investor gives you money, you put it in the bank, it goes on your balance sheet. I don't even know if it goes as like a loan or equity. It probably goes in as equity, but it's not really. So good luck with the accountants there. But anyway, as a founder, you probably don't have to worry about that. It's not debt, so it's not repayable, which is kind of awesome as a founder. It's the main reason why it's better than a convertible note, even though it's very similar. Convertible notes sometimes have interest as well, whereas a safe won't. So it all came from Y Combinator, and it's spreading all around the world because it's simple and fast and everyone's kind of gets it. So it's not a convertible note. There's no liquidation preference on it. There's no interest payable. So they give you the money, you don't have to pay them 5% interest or anything like that. We're going to talk about what the cap is in a minute and what the discount is. So the main two things on a note, on a safe, sorry, will be what's the cap and what's the discount. You'll get asked about that a lot. We're going to talk about that in a bit more detail in a minute. It has a trigger event. So the trigger event is when it converts from being a safe to being shares. So the whole idea is it's safe in the beginning and then it's shares later. What is a trigger event? It's almost always when you do the next round. And there's normally an amount on it. So the safe will say in the wording of the document, it'll say, if this company raises $1 million or more in shares, then the safe will convert, something like that. There's no maturity date, so it's totally open-ended, which is great because it stops you having pressure. Sometimes you'll do a 3-year convertible note and thinking that's a long time, but you get 2 years in and you're like, I really don't want to have to pay this note back. So yeah, no maturity date is another bonus for founders. So it's a lot more founder-friendly than a convertible note, and it's a cool document. So how it works for the investor. So it's mainly for smaller angel rounds. It just means that the investor can just get going and they don't have to get bogged down with the val. They get rewarded with the discount and the cap because they're coming in very early. The way it converts is either the cap or the discount. We're going to go into that in a minute. You can have follow-on rights as well, which angel investors really like. So you can write into the safe that the investors can follow on either on a pro rata. A pro rata is normally the preference. Otherwise, it could be first right of refusal as well, which is not as common. And then for the entrepreneur, look, they're really, really handy documents. You don't have to get a valuation done, which is always really difficult. It's just a simple document, right? Lower legal fees. You can have a rolling close. Like with a round, normally if you're raising $1 million, you got to get the whole $1 million in that whatever period, that 1-2 month period. Whereas with a safe, you might get a bit in this month and a bit that month and a bit that month, and you can keep the company progressing during that period. So super helpful on that side of things as well. I think that's pretty much covered all that. So in real life, just a simple example I tried to put together. Hopefully it actually is simple, but we'll see. So, you're doing a $300,000 pre-seed. You do it as a safe. You sign up 5 or 10 investors with a 20% discount and a $5 million cap. There's not much else you really need to know other than that. You really need to try and keep it as simple as possible. All the other terms and conditions or pretty much all the other terms and conditions are just standard. And then you go raise your $1 million seed round, $5 million pre-money. This might be the following, 6 or 12 months later. And the pre-seed and the seed are normally pretty close together, just because it's hard to raise a lot of money in the pre-seed and you run out kind of fast. A lot of you have probably experienced that already. Yeah, so in this case, it's a $5 million pre-money seed round. The share price is $1, but then you have to convert the safe, right? Because you've had a qualifying event, a trigger event. So has it hit the cap? Yes, it's bang on the cap at 5 million. And so therefore you would use the discount because it's the lower of the cap, or the discount is the share price that the safe will convert at. So in this case, the share price of the seed round is $1 and the discount is 20%. So the share price for the safe holders is 80 cents. Or another way to describe it would be a $4 million pre-money val for the safe holders, as opposed to a $5 million val for the seed round. So that's where they get their discount. That's where they get their return for backing you earlier. So they get extra shares, right? So I think that's kind of clear, but we can come back to that if it's not. So I borrowed this from my mate Dave at Hall Chadwick. It's very technical. I was trying to read it before, and it was like my mind was like trying to go to sleep on me because it's like so technical. Sorry, Dave. But so it's not debt or equity. It's sort of like in between, which is kind of confusing, but it is what it is. So you don't have to pay it back. Some safes, in the case of liquidation, so if the company actually kind of dies, sometimes the safe's paid back at that point, but most startups don't need to worry too much about that unless you have like a little bit of founder debt you were hoping to get paid back, but founder debt doesn't really exist anyway. So you should probably be thinking like that anyway. Anything a founder contributes is for free and or equity normally. What impact does the equity classification have? I don't think we need to. I mean, it's pretty technical stuff here. I'm just going to skip over to this one. At the time of conversion, is there a gain? Oh yeah, so there's no like capital gains tax event, which is kind of, a little bit of technical information that people might sort of be aware of. So, when it goes from a safe to a share, it's not a capital gains thing. A lot of you would like to talk, a lot of you would be aware of ESIC, so the early stage innovation company program. So the safes can create complexity here. So when they first invest as a safe, it's not an ESIC compliant investment because there's no shares being issued. It's only when the safe converts to a share, so when the trigger event happens, that the investment becomes ESIC compliant. So if you're very early stage and you are ESIC and your investors want to get the tax breaks, you do need to issue shares and not a safe, unless of course the trigger event happens while you're still ESIC compliant. So it's a bit of a mouthful, but if you're not sure, just sort of like talk to your accountant, try and work out when you're ESIC, when you're not, and it just could mean you should maybe do a share round instead of a safe round or whatever. So just ask about that if you're unsure, because it's quite a big thing, ESIC. Like if someone puts in a couple of $100,000 and you go gangbusters and they get 10 years CGT free, like it's pretty awesome for them. So it is probably worthwhile doing the right thing and checking all that stuff with your accountant and just making sure you don't muck it up. So like this is just, I thought I'd show you what it kind of looks like. All the main information is right here at the top of the document. So your company, the investors' details, how much they're putting in, the discount rate, the valuation cap, the capital amount, that's like how much the company has to raise for the trigger event. So all that stuff will be there in the agreement. And now, what are we trying to do when we're simplifying the safe into a safer note, and what are the areas where it can be a bit tricky? So Dave Kenny and Quinn from Archangel and I have been having a few meetings, and Quinton's lawyer as well. He's been doing some amazing work with some other lawyers in the startup space to try and work out how we can standardize this even more and get a little bit of consensus from the industry. So this helps founders. One of the big questions that comes up all the time is the valuation cap. Is it pre-money or post-money? And some of you won't even know what that term is, and that's fine. But like, just say a seed round could be I've got a pre-money value of 5 million. I'm raising 1 million. So I've got a post-money valuation of 6 million. So 5 plus 1 equals 6. It's quite clear. But the difference between 5 and 6 is not immaterial, right? That's nearly 20%. Must be about 17% or something. So if you think you've issued a $500,000 pre-money safe, but the investor thinks it's a post-money safe, it can cause quite a bit of a problem. Like 17% of $500,000 is not a small amount of money. It's a big amount of money, and it can not only cause you to have a fight with your investors, it can cause you to have less ownership of your own company just by having an accident or like not getting this stuff. So just be really clear. If it's pre or post money, just be aware of that stuff. Am I going for time? I'm going to take 5 more minutes. So it's an agreement, not a deed. And this is a bit nerdy, but you can't sign deeds online. You can sign agreements online. So just make sure if your lawyer's mucking you around there, it is an agreement. I think we talked about the trigger event. Yeah. So the trigger event is the next round normally. And we've talked about ESIC. So make sure you get ESIC right. If you use a safe and then your shareholders convert to shares after you're stopped becoming ESIC compliant, and then you go nuts and make them a lot of money and have to have a huge tax bill, like it's not a cool thing to do to your investors. So try to avoid that as best you can. And then so the valuation cap. So with the val cap, it's there to protect, in my opinion. So like this, I'm a founder, right? And while I try to be fair to investors, I do lean on the founder side. So if there's investors on the call, please don't hate me. And I'm trying to be balanced. But the valuation cap is an investor protection, in my opinion. It's designed to stop because they backed you really early, like on day one. And just say you happen to do like a 50 million pre-money val on your next round, it's not really fair that they get like 20% discount on that because they backed you from day one. So it's designed to be, in my opinion, you set the valuation cap around where the next round should be. So if you're doing your pre-seed, you look, I should roughly do my seed around whatever, and that's the valuation cap. That's how I would set it. Investors try and put the valuation cap like a quasi valuation on the current round, which I think is unfair. And that's a negotiation thing that you have to do. But at least if you're aware that, best practice would say it's a investor protection, not a quasi valuation, then it gives you a better chance of negotiating that. And that can be like literally like a huge amount of equity. Like that could be a 50 to 100% difference in the amount of equity that investor gets, right? So it's important that you're at least aware that you can try and negotiate that. It's not a valuation, even though investors will try and do it that way. And maybe they'll win. I don't know, but I think we should try and keep this conversation open. And then the pre-money, post-money thing we've already talked about. Unfortunately, whoever creates these documents have made it confusing with the discount. If someone said to me, I got an 80% discount, I would think, oh, well, if it was $1, I'm getting it for 20 cents. But that's the way they write it in the document, which is really silly. So we always say it's a 20% discount if that's what it's meant to be, but you will see it written the wrong way around sometimes. Just keep an eye out for it. Try and keep the language as clear as possible, just in case you don't have one bad investor that turns around and says, no, I expected an 80% discount. It doesn't really happen in reality, but that's the worst possible outcome in that situation. We think it should just be flat out 20%, like 20% discount. That's what a safe is. Let's just get on with it. It's so much easier. We do see them at 15 and 10 and people negotiating it. We're not really into that. Between, Dave and Quentin and I, we think it should be standardized. We sometimes see them with no discount as well, which again, I think is completely unfair because there's no return then really for the company, for the investors coming in early. I think Y Combinator's new safe is no cap, no discount, which is pretty wild that they've gone to that situation now, and they're taking on 1,000 companies a year. So I would recommend trying to get in there if you can. I think I might even apply. But yeah, so I don't think a no discount is fair at all for investors. And most investors, if you offer them a no discount safe, are just going to immediately ignore you because it's like, well, you don't respect me and my money and my time, and so why should I back you? or, you know, and that's, I kind of think that's fair as well, even as a founder. But I know some founders are like, well, I'll just get the best deal possible. And I respect that as well. And I guess everybody can make their own mind up about that. But I think the discount's there for a reason. So there's a consortium of us, I guess, that are working to actually build a safer note. So we're going to try and put things in there like, you know, how do you set the cap, and, you know, all these sorts of ambiguities or differences that we've sort of highlighted here. We're building those into a new safer note. So Quinton is on the lead on that at Archangel, and Dave and a few of us are helping with that in the industry, so we can make safe notes easier for everyone. So I think this will come out afterwards. There's a heap of resources in here, including the capital raising toolkit and safe templates and stuff like that. And these are Dave's details. If you want to talk to Dave, he's a gun at all this stuff, and he helped me with the deck. So a little shout out for Dave there. And yeah, if you want to get set up on Cake, it's free to set up. It's free to onboard. The first 5 investors is free. So if you're like pre-seed and you're looking to run a safe, you can literally set up a whole safe round for no money until you get your first few investors in the door before you even have to pay us, I think, like $29 a month. So please do check it out. It'll save you heaps of time and money. And otherwise, I think I haven't done too bad for time, Poppy. Is that cool?
You've done perfectly for time, Jason. Thanks so much. That was amazing. There was a heap of information in there. So I hope you're all paying attention at home. We've got a bunch of questions to get through as well, Jason. So I don't know if you want to have a glass of water and a deep breath, and I'll start firing.
Some coffee. I'll do my best. Remember, I'm not a real accountant or lawyer, but I'll definitely do my best. Actually, I am an accountant. Don't tell the CPA that, but you know what I mean.
We'll start gentle. So it sounded to me like safes are great. You know, you don't have to bother with the valuation stuff. You have the freedom to have multiple individual agreements without having to reach that like pre-agreed amount. There's no huge term sheets and documents, and the investors also get a discount for taking that early risk. So I was just wondering, it came through in a few of the questions as well. When would you not use a safe? And when would it not be an appropriate tool for using funds? What's the downside?
Yeah, so if you've got a pretty organized, well, the downside is you can sort of not know where your cap table's at if you do multiple safe rounds on top of each other. Like, it's hard enough to manage your cap table at the best of times. It's really easy to let it get away from you. And so just say you ran a $500,000 safe with a 20% discount, and then you ran $1 million safe with 20% discount, or like sometimes the discounts are even bigger. Like, it's really good times for raising now, but sometimes it's bad, right? And you might even have a 30% discount or whatever if you're having a bad year. And then you raise $1.5 million with a combined 20% discount, and then you might have a bad year, and then you go try and raise like another $2 million, but you can only get a $5 million pre-money valuation. So then you're like, oh my God, how do I fit all this equity in my $5 million valuation? Yeah. That is the biggest risk by far. So you do want to, as often as you can, do a price round, unless of course you're just backing yourself, you know, and we all should be, but still, like, I find it really scary when I see like too many safes, especially with discounts, because you could really cook your cap table. So yeah, in my opinion, if you've got all your investors lined up and you've got the time, just do a price round, just do a share round, because you've got it all locked in, and there's no like what happens in the future if I do a down round or whatever. Like, you've got the money, you've issued the shares. That's still, in my opinion, the preference. But if you want to do one quick, you know, round, or if you want to do 300,000 and another 300,000 or 400,000 and not go too far, then they are a great instrument.
Yeah. Okay. Yeah. So don't go wild and start issuing hundreds of them all on different.
I think they call it note stacking, and it's like, yeah, you got to be pretty careful.
Awesome. And presumably as well, Cake would be a good place to start if you're looking to keep a track of your cap table. So I'm sure you've got some resources.
It does help.
Related to that, we got another question through. The question was around whether they're being encouraged by the market or by investors. Is it often the planned approach by a founder before they even go out to raise, or is it something that investors are coming to founders with as a suggestion? Who's kind of leading the safe note revolution?
Yeah, I really think it's been quite a balanced thing between founders and investors. Everybody kind of has the same understanding, in my opinion, of what they're good for and when they're good, and that they are a nice, easy way to do around. And I believe, as we just described, it is very well accepted both by investors and founders. I think in reality, it's a more founder-friendly way to do it. It is more founder-friendly, and only really probably the better tech investors are cool with safes. Like, I think you're more conservative and or strict or old school early stage investors are probably a bit down on them, and I don't disrespect that opinion, because like, owning however many shares you want to own is a cool thing too. So I think it's probably slightly on the founder side, especially if it's like no discount, no cap or whatever, then it's really ridiculously founder friendly. So, and I have seen a bit of that, especially 2021. I don't know if 2022 is going to give you that much scope to do that. But yeah, I mean, I'm all for founder-friendly stuff, but you've got to be cool to these investors. Otherwise, they'll nick off and, not be here for us when we need them.
Very good point. Look after your investors as well. I'm going to jump into a few of the questions that we've got live through the audience. So a little bit related to what we just spoke about, actually, Jason. So Mayran has asked, is it kosher to provide a variety of caps or discounts to those participating in a safe round? And how, if at all, would you communicate the discrepancies or the variations to the other potential investors?
Yeah, so it certainly does happen. And you definitely can do it. So you could sign 5 different safes with 5 different caps and 5 different discounts. Like, they could be 5 completely different documents in reality. So that's like, it can be done, and it is done that investors will negotiate different deals. I think you would only do it if you had to, like, because it just creates so much complexity and so much more difficult for you to manage from a cap table perspective. It's so much more difficult for you to manage from political perspective amongst them. I mean, we wouldn't like to have them all at the same table at the same time, which is not the kind of vibe that you're trying to develop within your little team. So I have also seen it done where it's a bit staged, and I can sort of see the benefit and the logic to that. So like, the first couple of hundred might be at a certain price and the next couple of hundred might be at another price. I don't think it's cool if it's like a salesy, ratchety type thing, but I think if it's really sort of time-based and based on milestone and risk, then I think it's reasonable to have slightly better terms for the earlier ones, and then slightly worse terms on the way along.
Yeah. So it sounds like in previous jobs, we've called it the red face test. Like, would you be happy to stand up in front of all those other investors and explain those reasons why? Are they reasonable? And if it's based on that timeline of, well, they came in earlier and therefore their risk was like higher, then it makes sense. But if it's just they're a better mate and we gave them mates rates,
mates rates isn't cool. Someone mentioned, if you're getting the Atlassian founder, and like, what's funny in startup land is, even though you'd be happy to give them better terms, the most successful people will almost never want better terms. Like, they will be the most generous and fair and wanting the most transparency. And that's the whole thing we're trying to do in startup land, is just create this fantastic ethos of win-win.
Yeah, absolutely. So next question then we've got through from Toma, who asked, how common is a coupon in safe and in a seed round? There's a second part to the question as well, but I'll pause there quickly. How common is a coupon?
I think it's 0. I don't think it's interest rate or coupon. I think it's not applicable. You wouldn't even see it in the document. There'd be no field to complete or anything. With a convertible note, there can be a coupon. I think there used to be coupons, but like, making startups pay interest is like, it's cooked. That's not on. In my opinion.
Awesome. Yeah, and we did get a question actually. We got a question about the difference between a safe and a convertible note, but you answered that before, and that was the stuff around no debt, no interest, no coupon. Like, that's the difference, right?
Yeah. I mean, it's an evolution of the industry, I think, a little bit, just that we understand the risks, and it's just a little bit more clearly articulated in the actual document what's actually happening in the very early stages of a startup. Like, it's all or nothing. and that's the way the document should be, because the stress levels that can come from having documents that don't match the situation is just not cool.
Totally. And one from Dean Robertson here, who said, our safe just says valuation cap in the schedule. Should we change it to be pre-money valuation cap? Is that enough to clarify it?
Absolutely. Or put 5 million pre-money in the, as the answer for that term. Definitely. Really, really important to put that in there. Yeah.
Yeah, cool. Very clear advice there. Definitely do that. Another one through, we've got, what if there is no plans to raise a seed when you raise a pre-seed on a safe? Can you do it before you've got those plans for a seed?
Yeah, it's a tricky one. There are alternative trigger events that you could create for your circumstance. It's not as clean and clear, but you would try and, in my opinion, and I've seen this done before, you would try and find a balanced milestone for your organization. So it might be, we don't need a seed because with this first amount of money, we're going to make so much money, from this humongous contract or whatever, which is great. If you can do that, then awesome. But I would normally expect you'd still need to then go on and raise depending on your growth objectives. But just in case you want to grow a little bit more slowly or whatever, or you've got an amazing company with unit economics that we all can't achieve, that's good for you. But you would just then you might have like, once we sign this contract, it'll convert, or once we hit a certain amount of revenue, it'll convert. And, those sorts of things are normally doable with investors as well. Or you could even ask them, you could say, look, there's a couple of trigger events that we propose. Which one would you like? And as long as you're happy, then you can do a deal on that basis as well.
Yeah. Awesome.
Again, none of this is legal advice. How many times do I have to say that without actually like doing the wrong thing? Hopefully my head of ops and legal counsel occasionally watches these and kicks me if I say the wrong thing.
Disclaimers all round, please. No one sue Jason or us.
No, please. No, I'm sure we're doing the right thing, but yeah, just had to mention that again.
Next question then. Is there any scenario under which the documented discount applied to the safe changes over time? So, for example, to account for the case in which a raise is pushed out, an investor wants a term allowing for a deeper discount that kicks in from, say, 24 months on. So basically, how changeable are those terms once they're in the safe note? Can they be changed, or is that just locked in forever?
The actual agreement would be changed, but So if the investor signs a deal and you don't raise for a long time, then it's just about outcome for them.
Yeah.
As a founder, you can do whatever you feel is fair to bring the investors on a journey. We had a down round very early on in Cake, and we looked after our first investors, and that was a really good choice for us. So there's lots of things you can do with new agreements or new deals or to help them out or sweeten things, but that agreement is that agreement, so it won't change or get better or worse for anyone.
Yeah, cool. Next one, and this one I think is a bit of a tax question, Jason, so feel free to say no if you don't want to answer anything.
I'll do my best.
Ryan's asked, does the safe then create a CGT issue on eventual disposal of the shares given the low cost base?
So the cost base will be the share price at the point of conversion, so that in the example I gave, there was a $1 share price on the round, and the safe holders got 80 cents. So, if it was $100,000 times 80 cents, they'd have an $80,000 cost base versus whatever gain they made. And that's why that ESIC can be so important, is because when that $80,000 cost base gets set, you want to be ESIC compliant at that point, because then you get the really big CGT discount that the tax office is offering. So I think the cost base is reasonably similar to any normal sort of angel investment.
Yeah, cool. A few more to fire at you, Jason. Sorry, they're coming thick and fast.
Right.
Next one is from Jeremy Worthington. So we've covered this a little bit, but this is a bit more of a specific question. So are safes equally regarded compared to CNs, which I'm assuming is convertible notes, by investors? So SAFE seems much better for founders, but do investors prefer convertible notes?
It depends. I have certainly seen some investors say they won't do a SAFE. I've seen some say they won't do a note. I've seen some prefer SAFEs to notes. I do apologise, but it's all over the shop. It sometimes depends on what state you're in, what ecosystem you're in. I think like anything, it's part of doing your homework in the preparation phase is just check that when you talk, you're building that, they qualifying your investors before you actually open your round, just mention it's going to be a SAFE round. Is everybody cool with that? And if they say, oh, we don't, we only do notes, then you do a note or whatever. Like, it doesn't really matter as a founder. You just want to get the money with some good terms and get going.
Yeah, so it sounds like communication is key then. Just talk to your investors, do a bit of
your investors, ask them what they want at that last minute is probably the key, because it is quite variable.
Yeah, awesome. And a couple of questions have come through around other documents that you might need. So Sonu said, even though it's an open-ended term sheet, you still need the rest of the ops agreements, right? ? And we've had a similar one come through from Clinton that said, is there any other agreement documents that are used with a SAFE, like an NDA, like what might be in a shareholder agreement? So outside of the SAFE note, is there still other documentation?
So the basic company would have a constitution.
Mm-hmm.
We would normally advocate for a shareholders agreement. I think, in my opinion, the only time you wouldn't have a shareholders agreement would be the very beginning for a solo founder. We like shareholders agreements even for two founders, because then you can have vesting in, which we think is really important for those early years, just in case you split up for whatever reason. You've got a nice rule book for how that's all going to work, and whichever poor founder's left holding the bag doesn't have another founder, killing them. And I'm not trying to hassle anybody there. They're just important things to, handle those bad situations that can happen. So you would normally have that. The SAFE is a separate document. It's not necessarily directly correlated to the shareholders agreement. As and again, not legal advice. If you're really, really unsure, definitely talk to lawyers. There's good lawyers in the ecosystem there, I'm sure. And then when you convert from a SAFE to shares, there would be some sort of document, a subscription agreement, or a deed of accession, or some sort of document signed at that point when you become a shareholder, which ties you to the shareholders agreement or the constitution, depending on what the company has. NDAs, I think, I don't know why or if or when you would need an NDA. I normally advocate against them because I hate signing them, and I just think that they're a pain in the ass, and I think I'm not the only one. But if you really, really, really want one signed, I normally see that as a red flag, to be honest. So no NDAs. Unless you're coming out of university, you spend 10 years on some IP that doesn't exist anywhere in the world or something like that. You could probably get away with it, but you normally don't. It's not very common.
That's what we hear often as well. We get that question a lot around protecting IP and NDAs and stuff, but often ideas are a dime a dozen.
Yeah.
Someone else has probably
when I started out, I was really worried about it as well, and then the longer I've been in the industry, the investors are like, I'm seeing 500 deals a year, and you want me to sign an NDA that I'm not going to it's just not worth their time to even talk about it normally, sign it, because they can't. I mean, they literally can't honestly say they wouldn't. What are they going to do anyway? They're investors. They're not going to go start a company. Anyway.
Totally. Kind of related to that, but not quite. There's a few questions that came through around lawyers. So one's come through that says, when doing SAFE negotiations, is it best to have a lawyer present at the founder investor meetings? Should they actually come to the meetings? Do they just need to review documents? How would you engage a lawyer in this process?
The simplest way to do it is just to use all the cake documents and not have a lawyer involved. And if you're reasonably, we see founders doing that all the time. We partner with heaps of good accelerators, so they'll come in, they'll sign up, they'll start a raise, they'll run the whole raise, and they won't have any lawyers involved. So you totally can do that.
Yeah.
If you do have a lawyer involved, they normally just help you understand the document. They might help you tailor it a little bit. they might tailor it too much for you and cause you a whole bunch of bloody problems that you don't need, which is like a big risk. So like anytime they're really, really, really trying to put a heap of changes in your documents, especially early on, I would see that as a red flag, because it just creates problems with the investors and the next round. And if they're really, really negotiating with the investors, it's normally like it's just not necessary as long as standardized documents are being used. So lawyers are very good negotiators. Lawyers can be very good negotiators, though, so they can actually help protect your interests as well. So I think if you've got a good commercial lawyer and they do know how to negotiate, they can be good in that situation. So I guess it depends on your own negotiation skills, and if you feel like you need someone with that strong commercial, acumen to help you, hang tough. Like, I think with the safe note, it's less important. I think with the price round, it's more important. Sometimes when you get a term sheet, it's very difficult to understand the terms in the term sheet. In that circumstance, I would normally advocate going through the terms in advance with your lawyer as much as you can. So by the time you actually get given one by an investor, you're not like freaking out. And you can actually kind of like just be okay with everything, because it's a bit of a shock the first couple of times you see it.
Awesome. So it sounds like use templates, standardized agreements as much as possible, and that will cut down on the time you might need to use lawyers. But when it comes to equity agreements and things, you might want to chat through some
confident and you feel like your investor's doing the right thing, then I think you can get away with it. But like, there's a reason why lawyers earn so much. It's because it's pretty important stuff. So you might want to get some help.
Jason, I've just realized we've only got 1 minute left. We had a bunch of questions left. I'll just ask one more very, very quickly. How does it work internationally? Can you use Safe Notes, US, UK, Australia, everywhere?
Yeah, pretty much all around the world. The UK is the only one where it doesn't work so well, because they have the SEIS and EIS program similar to ESIC. So they really want to be issuing shares in the UK. So they do have a special thing with a slightly different name where they try to like hack it a little bit, but it's not a safe, it's something else. I can't remember the name, sorry, but pretty much every other country is running safes now, and they're really common. And Cake works in the UK and India and Singapore and the US. And also more recently, Kyrgyzstan and Dubai. So we're in 7 countries now. So if you need help in any of those countries, let me know.
That's awesome, Jason. Wow.
Thanks.
We better leave it there because we've just hit 2 p.m. But I want to say a massive thank you to you, Jason, for your time this afternoon, your expertise. I think, never knew half of the stuff that we covered today. So thank you so much. Any final last minute parting words of advice?
No, just good luck with your journey. Get your raise done ASAP, and go hard.
Awesome.
Thanks for having me.
I'm sure Paz will share the Cake Equity website in the chat, as well as maybe your LinkedIn profile, Jason, in case people had extra questions and they wanted to reach out to you.
Hit me up. That's what I'm here for. Jason at Cake Equity. Hit my team up. We've got an unbelievable customer success team. They're so helpful. You can have free sessions with them. Like, if you want to know more, like, definitely hit us up, because that's what we're here for. Yeah.
That's very generous. Thanks, Jason. I'd encourage you all to do that, obviously. Just a reminder that you can head across to the Startup Victoria website if you'd like to check out our memberships and find out a bit more about what we do and get more involved in the community. And that's all for now. Thanks so much for coming along. It's great to see you all here on a Friday afternoon. I hope you found that useful, and we will see you very soon. Have a great weekend, everyone, and stay safe.